Welcome to this explainer. We really need to talk about something incredibly urgent today. The traditional wage-based American career promise, basically that deal we were all sold growing up, is being silently dismantled right in front of us. And the scary part? Most people won't even see this trap until it's already snapped shut. But by the end of our time together, you won't be one of them. Understanding these forces, how they interact, and exactly what to do about them, well, that's the difference between being a passive victim of the system and a deliberate actor who actually protects and grows their wealth. I really want you to stop and reconsider that core deal of the modern economy. You know the one. Go to school, get a job, put money in a 401k, and retire comfortably. We take it completely for granted. But that entire sequence relies on a few fundamental gears turning smoothly in the background. What happens if those gears start running backward? Well, right now, three massive structural forces are actively breaking this system. This isn't just some fringe theory either. It's happening right now in the data as we speak. So, here's our roadmap to untangle all of this. We'll start with the causal loop, then look at how AI displaces career ladders, move on to the passive money illusion, cover external shocks, see how the railroad bubble repeats, and finally wrap up with your strategic framework. All right. Let's dive into part one, the causal loop. The absolute most important thing to grasp here is that these economic forces are not happening in a vacuum. They are a mechanical system and they actually feed on each other. Think of our economy like this massive engine. Step one, AI displaces millions of entry-level workers. That reduces overall wage growth for younger generations, and some estimates say this impacts nearly 30% of entry-level tasks. Step two, because those folks are making less, or maybe not even working in their chosen fields at all, their automated biweekly 401k contributions shrink. Step three, that shrinkage reduces the massive blind wave of money that mechanically buys into index funds every single month. When that passive buying weakens right as external global shocks hit, while the astronomically high valuations of tech companies begin to crack. Basically, breaking the entry-level career gear mechanically destroys the index fund inflow gear. It's a literal wealth trap. Which brings us to part two. AI displaces career ladders. See, the entry rung of the career ladder wasn't just made a little harder to reach. For millions of knowledge workers, it was removed entirely by AI. You always hear the headline unemployment number on the news, right? That's called U3. Back in May 2026, it sat at a seemingly normal 4.3%. But here's the catch. U3 only counts people who are completely without a job and actively submitting applications right now. It's kind of like only counting the people physically standing outside a factory with a will work sign. But there's a much broader, far more accurate metric called U6. U6 sits way higher at roughly 7.9 to 8%. Why? Because U6 includes everyone who just got discouraged and went home. It includes people who desperately want a full-time career but are forced to work part-time bagging groceries just to pay the rent. The massive gap between those two numbers represents millions of human beings that the headline number just completely ignores. And the data brilliantly illustrates exactly what's happening to the newest generation of workers. Since early 2023, overall entry-level job postings in the U.S. dropped by a staggering 35%. Young workers ages 22 to 25, who are in highly AI-exposed occupations, they saw a 16% drop in employment. For young software developers, it's nearly a 20% decline. You see, the apprenticeship ladder is totally broken. Historically, a junior financial analyst or a junior paralegal didn't write the absolute best reports or argue the best motions. They did high-volume, repetitive grunt work to build their competence. But that cognitively structured, repetitive work is exactly what AI does best. So companies are just using AI instead of hiring juniors. By eating their own seed corn today, industries are basically creating this terrifying future where we have software architects who have never actually laid a single brick. Okay, part three. The passive money illusion. So the wage engine is sputtering, and that exposes a really dangerous, widespread misconception that passive investors hold about the actual value of their retirement accounts. Let me explain this using a super simple physics analogy. Wealth and money are absolutely not the same thing. Wealth is like potential energy. Picture a massive boulder just resting on the edge of a cliff. It has enormous potential, sure, but it isn't actually doing any work yet. That is your stock portfolio. It is just paper value.
Money, on the other hand, is kinetic energy. It's the boulder actually falling. It is actual purchasing power. Your wealth only becomes money at the exact moment you sell it. And here is the kicker. That conversion event depends entirely on there being a willing buyer at your current price. If everyone panics and tries to sell their stocks at the exact same time, buyers vanish, prices plummet, and your potential energy converts into far less kinetic energy than your monthly statement promised.
And here's where that risk gets pretty extreme. Just look at the concentration in the market right now. The magnificent 7 tech stocks, Nvidia, Microsoft, Apple, Amazon, Google, Meta, and Tesla, they make up roughly 33% of the entire S&P 500 index. Think about that. If you buy a standard, allegedly safe, diversified S&P 500 index fund, 33 cents of every single dollar you invest goes into just 7 companies. Index funds used to be this nice, diversified cushion. Now, they're essentially a highly concentrated, massive bet on big tech. Which brings us to this absolutely staggering number, $200 billion. In the second half of 2026, 3 mega companies are slated to go public in a really compressed window: SpaceX, OpenAI, and Anthropic. Combined, they are looking to raise over $200 billion. To put that into perspective for you, total U.S. IPO fundraising for all of 2025 was roughly $45 billion. This upcoming wave exceeds every single venture-backed U.S. IPO combined since the year 2000. Oh, and the best part? None of these 3 companies are currently profitable. So you got to ask yourself, who exactly is going to buy $200 billion of unprofitable tech stock? Well, institutional investors, the smart money with armies of analysts, they've actually largely passed on this private market pricing. So the burden falls directly on the retail investor through a structural trap called fast entry. See, NASDAQ and the S&P are fast-tracking these mega IPOs right into their indexes. The problem is, an index fund does not analyze a company. It doesn't look at profitability or price-to-earnings ratios. By law, it literally just buys whatever is in the index. So if you hold a standard 401k index fund, you will automatically be forced to buy SpaceX, OpenAI, and Anthropic at whatever inflated price early investors decide to cash out at. It's an invisible transfer of risk straight into your retirement account, and it causes a massive liquidity drain from the rest of the market. Moving on to part 4, external shocks. Okay, so we have a weakened wage earner and a highly vulnerable top-heavy stock market. Unpredictable global events essentially act as pure accelerant on this wealth trap, and we can track this exact cascade starting in February 2026. A geopolitical conflict effectively closed the Strait of Hormuz. Ship transits dropped 95% overnight. The global oil supply crashed, and Brent crude spiked 65% in a single month. This mechanical disruption directly and immediately forced domestic U.S. inflation higher. By May, CPI inflation hit 4.2%, driven largely by those surging energy costs. And, as you probably know, when inflation rises, interest rates rise. The 10-year Treasury yield surged to 4.6%. But why does this actually matter to your wealth? Let me explain with a really concrete numbers example to show how rising interest rates instantly crush growth stock valuations. Imagine a company earns $10 a share and its stock costs $200. That gives you a 5% earnings yield. Now, if ultra-safe U.S. Treasury bonds are only paying 1.5%, taking a risk on that stock for a 5% return makes total sense, right? You're getting an extra 3.5% for your trouble. But what happens when that external shock pushes the safe Treasury yield way up to 4.5%? Suddenly, a risky stock paying 5% looks terrible. Investors are going to demand a higher return, say 6.5%, just to justify taking on the risk. Now, for that exact same $10 of earnings to yield 6.5%, the stock price physically must drop from $200 down to $154. The company didn't change, their product didn't change at all, but the stock loses nearly a quarter of its value simply because the interest rate environment changed around it. It's literally gravity for financial markets. That leads us to part 5, the railroad bubble repeats. I know this all sounds incredibly daunting, but take a deep breath because we have actually been here before. Anchoring this current AI boom to history shows us exactly how to survive it. The absolute closest historical parallel to today's AI frenzy is the railway mania that triggered the Panic of 1873. Railroads were a genuinely transformative technology, just like AI. The long-term value was very real, but the speculative investment mania surrounding it was a massive bubble. History gives us 3 archetypal rules here, and you get to choose which one you want to play today. First up, Andrew Carnegie. He didn't gamble on which railroad company would win. He just sold steel rails to all of them. He owned the physical infrastructure. When the bubble burst, he was totally fine. Today, that's companies like NVIDIA or data center providers. They're selling the picks and shovels. Second, Cornelius Vanderbilt. He knew the technology was real, but the prices were insane. So he stayed highly liquid. He patiently hoarded cash. When the bubble burst, he swooped in and bought distressed railroad assets for pennies on the dollar, building a massive fortune. Today, that's the patient investor holding short-term cash equivalents. And third, Jay Cooke. He was the financier who kept selling railroad bonds to retail investors, farmers, small savers, long after the smart institutional money had run away. When the crash came, his firm collapsed, and the retail investors were left holding the bag. Today, the Jay Cooke equivalent is that massive IPO machine, dumping $200 billion of unprofitable AI companies straight into your passive index fund. Finally, Part 6, the strategic framework. So the absolutely crucial point here is, how do we avoid being Jay Cooke? I promised you clear, actionable steps to ensure you end up on the winning side of this economy. And here they are. First, take the Carnegie position. If you're going to invest in AI, own the infrastructure layer. Look for companies with real current earnings, like semiconductor manufacturers, grid power companies, or cybersecurity firms that get paid regardless of whether OpenAI or Google wins the AI software war. Second, build a Vanderbilt reserve. Hold short-term liquid assets. This isn't just an emergency fund. It is a positioned waiting strategy. Short-term Treasury bills, or T-bills, are currently yielding over 4%. That is real money, principal protection, and instant liquidity, so you have the dry powder ready to buy when the correction actually happens. Third, practice duration management. Remember our rule about interest rates? When rates rise, existing long-term bond prices fall dramatically. Move towards short-term bonds that mature quickly. And utilize TIPS, Treasury inflation-protected securities. With a TIPS bond, if inflation is 4.2%, the actual principal value of your bond adjusts upward by 4.2%, protecting your purchasing power. And fourth, use equal weight indexing. Instead of a fund where 33% of your money goes into just 7 tech stocks, an equal weight S&P 500 fund puts exactly the same amount, about 0.2%, into every single company. It drastically reduces your concentration risk. I want to leave you with a really direct challenge today. Think about this. Which historical role is your portfolio playing right now? Seriously, are you Carnegie, Vanderbilt, or Jay Cooke? The wage engine is slowing down, the stock market is dangerously concentrated, and the external macro shocks are mathematically pushing valuations down. It's time to take deliberate action. Here's exactly what I want you to do today. Schedule a conversation with your financial advisor. Show them this explainer, if you have to, and ask them 2 specific prepared questions. What is my current concentration exposure to the Magnificent Seven, and how is my portfolio protected from the structural forced buying of the upcoming $200 billion mega IPOs? Don't let your wealth remain just potential energy sitting on the edge of a cliff. Take control, manage your risk, and protect your future. Thanks so much for joining me for this explainer, and I'll see you next time.